Thank you for joining us for Consumer Financial Services Outlook 2022 here at Venable. My name is Jonathan Pompan, partner and co-chair of our Consumer Financial Services Group, and thank you for joining us this afternoon. Today's session is going to be chock full of highlights and important topics that are going to be relevant to your practices or your companies in the next year and probably beyond. This is a curated set of issues and topics and slides and presentation by a number of subject matter experts, members of our practice here at Venable, who do this day in and day out, support many of you already, and certainly would love to support those that we can in the future. So without further ado, I want to introduce my colleagues. Alan Burge. Alan?
Hello, thanks for joining.
Andrew Bigger.
Hi, everybody. Glad to be here. Thanks.
Mike Bresnick.
Good afternoon.
Sarah Donovan in our legislative shop.
Hey, everyone.
Len Gordon.
Good afternoon, everyone.
Alexandra McGarris.
Hello from New York.
Chris Scribner.
Hello, everybody.
Julia Thomas.
Hello, good to be here.
And Catherine Marshall.
Hello.
Well, thanks again, everyone out there, for joining us today. I see a lot of familiar names, and it's great to have you join us because for a lot of reasons, we're not always out in the field like we used to be. Certainly, we know many companies are not as well. We look forward to starting, and in fact, we've already started a lot of different conferences and look forward to seeing folks out there, as well as hopefully at your offices, but certainly virtually as well. It's sessions like this that we love to do. We love to share our knowledge. We love to highlight what the issues are, kind of hopefully maybe see around the corner and help provide you the kind of support that you need to support your clients day to day and then throughout, and especially even your careers too. We know this is a time of change. A lot of folks have moved around. And so from that perspective, it's always great to reconnect and also share what we know so you're ready to hit the ground running for 2022 and beyond. Now, in addition to that, this is really one way, unfortunately. There is going to be an opportunity for you to ask questions. We can get those inbound, answer them during the session and later. But if there's anything that you have on your mind that you'd like to ask outside of this, please feel free to reach out. And also, too, already at the end of 2021, we did a lot of one-on-one CLEs with clients and friends. And if there's ones that anything that you'd be interested in for us presenting on to your team and to your colleagues that you think might be relevant, if we can make it work, we'd love to. Certainly, please feel to reach out and connect with us, and we can try to make that happen. Now, in addition, today, of course, there's a little bit of admin I need to get through first before we really start. Today's session is going to be recorded. It's also, of course, not legal advice, but rather just general educational information. Because this is going to be on YouTube, you'll be able to see it. You'll be able to pull down a transcript if you want. There's also, of course, going to be the PowerPoint deck that's associated with this. And in addition, we'll send that all out to you after the session, probably towards the beginning of next week with the CLE certificate if you need it. And then today's session being for CLE, we'll do a code too. We have a record of who attended as well, and we can set you up with that. Now, today's session and the regulatory and legal environment for consumer financial services is really dynamic, and it's really a lot different than it was last year and certainly in years past. We've been doing these now for roughly 10 years. And when we do them each year, it's always astonishing. First, I think we're usually pretty good on what is the outlook actually happening. Now, obviously, we can't control what happens out there in DC and elsewhere. But we're pretty good at predicting what's happening in terms of like what are the hot issues, and I think identifying and empowering people to make informed decisions as to whether or not they need to dig deeper into an issue or not, and giving you the tools that you need. But this is a dynamic environment, one where the themes are becoming clearer and clearer with actions that are happening on a daily basis. even starting towards the end of 2021, the themes have shifted considerably. You have now, for really the first time in the Biden administration, you have a new CFPB director, Rohit Chopra, who's carrying on from the acting director, David Aweju, and really pushing the boundaries of really what the scope of the organization is and the jurisdiction, even pushing into areas, including competition, but even taking a step back, launching inquiries into markets that heretofore the CFPB has not been directly interested in: payment services, BNPL, and of course, reinvigorating fair lending in a fierce way. In addition, you now have a marketplace where AI and machine learning is taking not just a back seat, but really a front seat, not just to valuation decks for fintechs and neobanks, but is being integrated heavily into all sorts of operations, and then coming up to the surface in terms of potential legal and regulatory work that needs to be done throughout the product development and life cycle of a financial product or service. And certainly, obviously, there's direct service providers to banks and non-banks that are almost solely AI services and the like. In addition to all of that, in the payments world and in cryptocurrency, banking as a service, there's just a ton of hot issues there. As well as also, of course, the standard, but still important regulatory agenda that's proceeding and marching along, changing the law as it is for consumer financial services, some of which has been ongoing. We'll update you on a handful of them. And then we're going to switch into talking about also, in terms of scope and broadness today, consumer privacy issues and data security. Those are the ones that perk up in product development and elsewhere, where folks need to be proactive, hopefully, in addressing them. As lawyers, we're always in a position, I'm sure you are, where we know that oftentimes there's a lot of those issues that can easily be sort of segregated and handled separately, but instead, really from an integrated approach. It needs to be thought through, I think, holistically often. There's a lot of developments there, and we have two colleagues to share info on the outlook in that respect for consumer financial services and adjacent spaces that would be relevant to your practices. And over the years, when we get feedback and comments from folks, it's always about, actually, a lot of the praise for these types of outlook sessions is around the content we provide that is adjacent to sort of the core consumer financial services areas, because that's not the ones that folks are reading about day in and day out, but are the ones that, for issue spotting at a minimum, can be really important, demonstrate value to your client, and then also put you in a position to help in a way that multiplies and accelerates what your teams are doing in-house and what your companies are able to accomplish from a business perspective. And then we're going to talk also a little bit about supervision, enforcement, and some of the trends that are going on there. Now, with a little bit of a focus on CFPB, but certainly also more holistically as well. And if we have time, we'll throw in some more on state trends, some pending legislation, some observations from there, empower you with information that would be useful. But without further ado, I'm going to switch now to my colleagues, Chris Scribner and Sarah Donovan, who have been tracking what's happening on Capitol Hill and with the administration. When we did this last year, we were still in the old administration, and Congress had just reconvened. So a lot has changed.
Yeah, thanks, Jonathan. Thanks, Jonathan. Sarah and I will provide a brief high-level look at some of the key trends in Congress and Congress's relationship to the agencies. And in many ways, the priorities of the Biden administration haven't shifted too much in the economic policy, financial services space, although kind of the emphasis and the cadence of some of that activity will change a little bit. But to a very large extent, big focus on climate and climate-related financial risk has remained and will continue. Diversity viewed very broadly as questions of equality, access to financial services, inclusion are really important, have been important, and will continue to be. Cryptocurrencies, I said, is a continued priority in many ways. Obviously, the really sort of explosion of marketplace activity in 2021 kind of pushed that up the priority list a bit for the administration, certainly for the regulators and for Congress. I think from our perspective, and this is still the case, and we talked about this in past presentations, personnel is very much policy. We have seen a lot of key appointments, CFPB in particular. So in some cases, there are still acting directors at the OCC, for instance, although we think Michael Sue is the lead to get that position on a non-acting basis. And at the Fed and other key agency appointments, FDIC as well. But in the personnel issue, one thing to emphasize as we also talk a little bit about politics is that even though there's a Democrat-controlled government and narrow majorities in the House and Senate, obviously the administration, there are significant divisions among Democrats in terms of simply the moderate or progressive wings, or the moderate and the Elizabeth Warren wings of the party, as sometimes we think about it, that really affect Democrats' ability to legislate. And even as we saw with the one failed OCC nomination to nominate people to lead the agencies. As we think particularly about activity in Congress, a major difference between 2022 compared to 2021 is, in many ways, the Senate Banking Committee, the House Financial Services Committee were focused predominantly on sort of pandemic-related relief, reviewing pandemic programs, making sure there was opportunity and access to those programs and that they had been fairly administered, at least those that were able to get money out the door. And in some cases, also driven by market events, thinking of a series of hearings in the House Financial Services and Senate Banking related to the GameStop, issues broadly defined, as well as increasing activity around cryptocurrencies, particularly stable coins, which is sort of a very kind of key aspect of both the retail and kind of the wholesale use of cryptocurrencies. The staff for both committees, the Democratic majorities, have emphasized to us that their goal in 2022 is to focus more on core banking issues. And as we think about some of the hearing topics that we know are top of mind and will occur in the first half of 2022, those include cryptocurrencies, particularly a focus on stable coins. And we expect a Fed report on central bank digital currencies very shortly. That will also might help guide those hearings, but a real focus on consumer issues and consumer products. And as particularly in the House, to focus on overdraft, even as there seems to be some significant market activity on overdraft, the House is expected to hold House Financial Services expected to hold a hearing, very focused on the buy now, pay later market. And we'll certainly hold a hearing on that topic, as well as other credit or consumer products, credit cards, and an interest in credit reporting. Fair lending continues to be top of mind for the committees, particularly for the House Financial Services related to algorithmic use of algorithms in lending decisions, although the staff has indicated to us that they intend to defer to the CFPB, who's also moving on some of those issues. So in many cases, I think that obviously the House Democrats are very comfortable with Rohit Chopra leading the CFPB and are, very, to be kind of underline or, soft sell the point that they feel much more comfortable with the new leadership at the CFPB. Other issues include focus on the housing market, particularly private equity or hedge fund acquisition of housing and how that affects particular local markets and home prices, mergers and acquisitions in the bank space, which can impact consumers. And that's a particular focus concentration or loss of consolidation and loss of services, and also a focus on small business lending, particularly as it relates to minority deposit institutions and CDFIs. One thing we'll really see in 2022, and we did see in 2021, and probably it's some ways surprised at how much there was coordination between the Senate banking committees and the committee staff and the House Financial Services staff, often overlapping or similar hearings, week after week. So real coordination there, but wanting to look more broadly at some of the other issues that Congress will take up in 2022 and some of the impacts that politics will have on that. I want to turn it over to my colleague, Sarah Donovan.
Thanks, Chris. Glad to be here. I'll take you through how we're seeing 2022 how it might shape up, and then a little bit beyond that into next Congress. So now that we're in an election year, it really means that we're in a compressed legislative time frame, a compressed schedule. And so Congress will be effectively wrapping up by spring, early summer at the latest. And that's because members need to focus on campaigning. I mean, I hate to sound very DC, but I mean, that's the reality. Primary season is beginning in March with Texas. By the end of June, you've had 60-some% of states go through their primaries, and then you're on to the general. So from a practical standpoint, that means the window for significant action is really Q1. You can kind of get into Q2, but if something is still hanging out there by June, we can pretty much assume, barring any, crisis that needs to be dealt with, that things are pretty much dead for the year. And that would include something like the Build Back Better. If that's still dangling out there in June, I mean, we're going to call it quits here. So leading into what does that mean for legislation, particularly ones that your companies and your organizations care about. Build Back Better. I think that the media is still trying to kind of write things about this, but there's not really any current negotiations happening. We might see an effort for a slimmed down bill, but right now there's not really a lot of talk happening there. On appropriations, the Congress needs to fund the government. There's no real appetite to shut it down. The current continuing resolution runs out mid-February. So there's a couple options here. One is they could pass an omnibus, which is all the government funding bills, and then it takes us through the end of September. Another one is another CR, which as of right now, we think is the more likely scenario, and that will run through the end of September with some anomalies, meaning that there can continue all current funding with some exceptions. And another combination, of course, is a Cromnibus, which is another completely made up DC word that we could see, where they take some pieces of it and continue them, and the others they have a new year, funding for. So I think right now our money's on a continuing resolution, and that means that you'll probably have another one in September that takes us until after the elections. They're not going to work to go pass a big omnibus government spending bill right before the campaigns. And I have to note, a deal on appropriations and anything else that rides on that, whether that's COVID funding or something else, is sort of inversely tied to progress on other Biden agenda items. And by that, I mean Build Back Better, voting rights, that sort of thing. I mean, whether or not Republicans will pay ball on appropriations is inversely related to them feeling like they're going to get hung out to dry, or something's going to happen that they're not going to agree with, otherwise. So filibuster and voting rights, there's been a lot of press about this recently. There's a current push in the Senate to have action on this week by MLK Day, which is on Monday. But right now, there's not currently a deal on either one of those things. So we can kind of put that aside probably too. Jonathan, if you want to switch to the next slide, I'll talk about the elections themselves and some of their implications. Some trivia for you. Since World War II, the president that's in the White House, his party typically loses on average about 26 House seats in the midterms, and Republicans only need 5. So there's been a few exceptions around the Clinton impeachment, when Newt Gingrich and others really botched their response. Democrats picked up seats then. And then after 9/11, when W was in the White House and Republicans picked up seats. So there's exceptions, of course, always, but on average, it's about 26 seats in the House. So it's likely then that Republicans are in control of the House next Congress. In the Senate, it's obviously very tight as well. Republicans need to pick up just one seat, but that means they also have to hold on to not only pick up a seat, but hold on to seats in competitive states. And a lot of those have some unsettled primary contests. And there's been some very colorful characters in the races. I'm thinking in Missouri, in Pennsylvania, and others. So, I mean, that's a real uncertain. It's very uncertain right now who they're going to end up with. Both sides have targets that they really feel like are, opportunities to pick up some seats. But I think overall, what happened in Virginia and to a lesser extent in New Jersey really reset expectations for both sides in terms of what's possible. Regardless of what happens in, the Senate, you've got a Republican House, you are returning to a divided government. And that really puts the focus on the regulatory agencies, because you're going to have very few major pieces of legislation get signed into law. You're going to have, even if you have a Republican controlled Senate, you still have to get it past a Democratic White House. So really that just puts the focus then again on the agencies themselves. And so, Jonathan, we're happy to answer questions now. We can save them till the end, but that sort of concludes our legislative outlook.
Thank you, Chris, and thank you, Sarah. And I don't see any active questions right now. Please feel free, folks, to send them on in. And again, we'll try to work them into the presentations as we go. Certainly, we're going to cover a lot more territory to go in this Consumer Financial Services Outlook 2022. And I'll turn it over now to my colleagues and partners, Alex McGarris and Len Gordon, because the regulatory agencies are hot. And certainly a key focus of that is the new director at the CFPB, Rohit Chopra. He's really not the new director because, in fact, he may have even been a shadow director back when he was there the first time. But for folks that don't know, Rohit Chopra was the student loan ombudsman for many years during the Cordray era at the Consumer Financial Protection Bureau, then went to a Washington, D.C. progressive think tank for a short period of time, ended up being a commissioner at the Federal Trade Commission, where our partner Len Gordon had worked far prior to that in the Obama administration as the head of the New York regional office of the FTC. So, Len, you've been following Chopra really since his time, not just at the CFPB, but really also because he was a commissioner at the FTC. He's intersected all of our practices in so many different ways. I think what is your reaction to how he's been already not just quietly, but I think quite loudly moving the Bureau forward in its progressive agenda?
Yeah, Director Chopra has a very ambitious agenda, and he always has. He had the same thing at the FTC. He is a huge fan of both specific and general deterrence. So when they bring enforcement actions, he wants companies to be hurt, and including individual pain for the people who are running these companies and for the companies themselves. So on the enforcement side, I think you're going to see very harsh penalties. He is, I would say, generally hostile to industry. When he was at the FTC, he would not meet with trade groups, industry groups who would come in to talk to him about rulemaking or policy issues. He refused to do that, which was a real departure from past FTC precedent. How much he continues that practice at the CFPB, I think we're still waiting to see. It's a little odd because it's not easy to have face-to-face meetings right now. He clearly is trying to expand the role of the CFPB to deal with his concerns regarding the size of big tech and the use of data. And we're not just talking about data breaches here, we're talking about legitimate normal uses of data that he and his former colleagues at the FTC have serious concerns about the way it's used, and really want to fundamentally change the way data is used in the economy. Not just by the big four, but by everyone. Perhaps signaling his hostility to business as usual. He is hostile to sort of the revolving door that Washington operates. He has issued new guidance about engaging with former employees, and I think he's going to try and tighten the rules there. He's made comments about the same thing about the FTC. We'll see what actually happens, but sort of the way things normally get done, business as usual in Washington, he is generally hostile to. I think he views himself as an outsider, as does his colleague Lena Khan at the FTC, and we'll see how that actually results in getting things done.
Yeah, I'll add a few comments. It's really hard to talk about Director Chopra and the CFPB under him and where it's going to go in the next few years without also talking about his tenure at the FTC and where the FTC is going in the next few years, especially when it comes to enforcement and the overlapping jurisdictions in consumer financial services, which both agencies in many respects still do overlap. His time as a commissioner at the FTC was very active, and he very clearly articulated in writing and in multiple dissents and concurring opinions kind of his vision for the role of then the FTC, I think now the CFPB, the role of regulation and government in general, and an enforcement philosophy. And so I know we're looking at the CFPB now, but I think this will also apply to the Federal Trade Commission because the current chairwoman, as Len mentioned, protege of Chopra, they're cut from the same cloth. And I think a few things, a few kind of trends or issues that we're going to see, and I invite Len to comment on all of this. We deal with this stuff together, but one thing is we're going to see increased coordination and blending of missions. I think that's both inter and intra-agency, and Len can talk about the FTC and the antitrust and consumer protection missions potentially being blended, but we think we'll also see the CFPB and the FTC coordinate better and more. And given what they're planning and the aggressive and ambitious agenda, they probably have to.
I think that's right, Alex. And one of the things that's impacting all that right now is that currently you have 2 Democratic and 2 Republican commissioners at the FTC. A third Democratic commissioner, Alvaro Bedoya, has been nominated. He was nominated last year. His nomination expired. He has now been renominated. There does not seem to be a great deal of urgency by Leader Schumer to accelerate consideration of the Bedoya nomination. Perhaps that's because Senator Schumer's former protege, Rebecca Slaughter, is a commissioner, and I think he was pushing for her to get the chair, and she didn't. And that may impact his urgency in getting Bedoya confirmed. It's interesting, but Bedoya, Slaughter, and Republican Commissioner Noah Phillips all worked together on the Hill on the Senate side, and actually had a reputation as sort of a gang of 3 who got things done. So if Bedoya is confirmed, it might make the FTC a bit more bipartisan and functional, because right now, frankly, it's not. Chair Khan has really consolidated power into a small cadre of folks in her office, and is, by all accounts, sort of micromanaging things. Both she and Chopra were very critical of the way the FTC had done things previously. Those who work at the agency weren't particularly thrilled with that criticism. There's been a departure of senior leaders at the FTC. And, Chair Khan may think that's a good thing, but I think those of us who work with the agency frequently and have valued sort of the continuity of regulatory approach and the incremental way things were changed are worried. The Chair Khan, I think, really wants to sort of rule by fiat, and I think that's going to be a challenge. If Bedoya doesn't get confirmed soon, I think you'll see her sliding things over to the CFPB that are within the CFPB's jurisdiction, and Chopra has a very, very, very broad view of what that jurisdiction is. So, expect more there. There's a real emphasis at the FTC on rulemaking. What actually gets done, we'll see. They're talking about issuing rules regarding unfair methods of competition, which the FTC hasn't done in decades. Whether they have the authority to do that is hotly disputed. Chopra and Khan wrote a law review article last year saying they do, but there's a lot of smart people out there who think they don't. And if those rules get pushed out, there will be a tremendous amount of challenge to them. There's a real focus on what the FTC is now calling surveillance advertising, targeted advertising, and it's being focused on both as an antitrust and a consumer protection issue. And I think that's a really good microcosm for the way the FTC is looking at things. You'll see on the top right the memo that Chair Khan wrote to the staff at the FTC in response to criticisms that no one at the agency besides her seemed to know what she wanted to do. So she wrote sort of a manifesto that set forth her priorities. And one is to really blend the missions of the two agencies. But there are statutory differences in the authority and the powers that the two different bureaus have. The Build Back Better Act had provisions that would give the FTC civil penalty authority it previously lacked, and would also give it $50 million a year to build up a separate privacy bureau. Whether that remains in any revised legislation remains to be seen. They've resurrected some old tools, the penalty offense authority on for-profit education, money-making opportunities, the use of endorsements and testimonials, whether they actually end up bringing cases there or they just use those as sort of a interim tool remains to be seen. The commission is very focused on private equity and other investors, very hostile to mergers, both vertical mergers and horizontal mergers, putting conditions on mergers that are abandoned. So a real hostility to mergers and bigness. So a very European view that big is bad. And what that turns into from enforcement remains to be seen. I think one of the challenges Chair Khan is going to have is she has a really long list of things she wants to do and a really small agency. The rulemaking is incredibly labor intensive and could suck up an enormous amount of resources. So what actually gets done, especially if the commission remains tied to remains to be seen. But she would like to fundamentally change the agency. I think she'd like to fundamentally change the U.S. economy. Let me turn it over to Alex to talk about state AGs.
Yeah, so I mean, one thing that I think is obvious, and it will become more obvious as my colleagues describe kind of specific markets and regulation in the coming hour, is that both the CFPB and the FTC are prioritizing everything and have their eyes set on a very ambitious agenda that does, I think they hope, fundamentally change the way those agencies operate, but also, you know, the market. And so they're not looking to make changes at the edges, but really to move the needle. That requires a lot of resources, a lot of patience, a lot of luck. I think that it also will result in a lot of litigation, both from challenges coming from state attorneys general or industry, like state AGs in Republican-led states, and also industry groups, but also as a result of it being impossible to settle, and we'll talk about that. But as a result, litigation bogs down resources, and I think that the state attorneys general will pick up the slack in bringing kind of more plain vanilla civil fraud, consumer protection cases. We haven't seen that much other than data breach cases in terms of like larger settlements or multi-state settlements where more than one AG office teams up to investigate and bring action against a company. But I expect that will pick up. And I think the kind of industries and practices that have been traditionally high consumer contact, high volume of complaints will still be the AG's main focus. So that means, debt collection and, data security, what happens to your information, but also, lease to own and buy now, pay later, which is we're going to talk about more substantively because those lending options both have less regulation and also, target customers that are historically disadvantaged or don't have access to credit and capital. And so I think those will continue to be scrutinized. And even, the California Department of Financial Innovation and Protection, it's, the revamped California Department of Business Oversight, about a year since its new authority passed. I think there was a lot of expectation that California, being California, was going to come, guns blazing. It's been relatively quiet. I think looking at the strategic plan the DFPI set out, which is to build relationships, understand innovation in the financial products, in financial products, financial education, and making sure consumers understand the agency's mission. They've actually stuck with that. They haven't really come out with many enforcement actions at all, but they did recently issue one in a rent-to-own space. It's been months since they've really had another enforcement action, so that is pretty telling as to what the states are interested in. And then one final point, as I mentioned, it's going to be harder to settle cases. At the end of this webinar, if we still have time, we'll hopefully get into some of the reasons why and the practical consequences. But I think you're going to see companies not willing to take what's being offered, which is going to require, I think, from both the FTC and the CFPB, for individual executives and directors and officers to be named defendants in these settlements, which have a lot of consequences, but also the monetary penalty that the agencies are going to want to extract in order to sign off on settlements is going to be too high. And I think the injunctive relief, given the types of practices that they're going to be targeting, probably not worth settling. And so I think we're going to see a lot of law being made in the next couple of years. And with that,
there's no question that there's regulation by enforcement, and then there's also regulation by enforcement with a scalpel or a bludgeon. On the federal level, it looks like it's going to be both, and then on the state level, as Alex mentioned, even DFPI went out guns a-blazing within the first 2 weeks of its the sort of new authorities, sending out a press release announcing all the people it was going to investigate. Some of that hasn't come to fruition, but they have also pushed the envelope in some of their consumer finance lenders' enforcement activity. And on the multi-state level, they move at a trickle, but any company that's under a multi-state or even just multi-state, meaning more than one state attorneys general, it's all relative, and there can be any amount of disruption and then parallel actions happening too, because all of these regulators are looking at the same, really at the same issues. And to dive into the issues now, really one of the key themes has been the focus on tech. And we've already hit on it a bit. It certainly has made headlines, but Andrew, Rohit Chopra, really went guns a-blazing in some respects because right after he officially took office, he made this announcement here on big tech. What are some of the takeaways here?
Thanks, Jonathan. I think, a lot of the takeaways are a lot of what we've already talked about and what we're going to continue to talk about during this presentation. These big tech orders got a lot of attention. They came out in October 2021. And initially, they just, were sent to a couple of the large companies, but some of the developments are going to be relevant really for everyone. First, as Len and others have noted, it reflects the federal government really scrutinizing the large tech companies, kind of the big is bad mentality. Second, the types of issues that the CFPB is asking for through this market monitoring authority really reflects the issues that are hot right now within the CFPB and the FTC and others. Data use, fair lending, which we're going to talk about, some of our colleagues will talk about later, even antitrust and competitive issues and how data or access to various different services can increase market power, for example. Another kind of takeaway from this is that this was really one of the first large uses of the CFPB's market monitoring authority to aggressively gather information. And as I think Jonathan may talk, this authority is already being used again by the CFPB. And so maybe this is something to expect a lot more of moving forward. And there's still a lot of uncertainty around how the CFPB is going to use the information it gathers. at least with these big tech orders, the scope of information that they asked for was massive. I mean, asking really about all facets of these companies' activities. And will that information be used in any kind of rulemaking? Will it be used simply for internal information? Or is it kind of a prelude to maybe some enforcement in the future? These are all things that we don't know, but I think that this order is a good example of what the agencies are focused on and where they're looking to go.
Yeah, and these orders too, what's really interesting, and so there's a second one too, which has already made headlines, not to steal our thunder, but on buy now, pay later, are really essentially investigations through market information requests. The CFPB has specific authority to look at markets, and but it also has separate authority to do investigations, and investigations come with some degree. Sometimes it's arguable, but certainly under the law, supposed to have some due process. And so there's a real rift there that has now been used twice. And then, here in this particular one, looking at payment systems and big tech, in the words of the consumer groups and the CFPB itself, tech companies, when they're designing payment systems and various offerings, there are aspects of the potential for any number of areas to be triggered. It's not just sort of like solely a loan product. It's not solely a payment system in some cases. And so it's bringing in and also revealing the themes that we've already discussed today. And then in addition to that, another area that has been big is in fact buy now, pay later. And, we think that this is no coincidence. Ellen, we've talked about this a lot offline. This request from the CFPB to multiple buy now, pay later lenders came about literally the day after the response was due to the prior request to the payment systems providers. Tell us a little bit about what's happening and your reaction to what's happening with buy now, pay later.
Yeah, I mean, I think this is a response to the huge growing popularity of it. We know it's global. I mean, international usage of this. A lot of our countries have been looking at this for a couple of years now. But I think in the U.S. we really have a spotlight on it now. There was a House Financial Services Committee hearing about this in early November. We now have the CFPB coming in. It's one of these things where we see it. When I shop now, you can see it on consumer-facing websites. You can buy anything almost with buy now, pay later, and it's really popular among Gen Z consumers who sort of like the installment plan that it offers. But the real concerns that that are being looked at here in Washington and at the CFPB is this really allowing people to spend more than they can, to buy everyday purchases with buy now, pay later, that they can't, they're racking up a lot of charges. They've got multiple payment schedules that they can't keep track of. There's no system for getting monthly statements on how much you owe, and then potentially hidden fees if their payments are late, or if somebody has to reschedule a payment or whatever it is. So this is all being looked at right now. Jonathan, maybe go to the next slide, and we can get in a little bit more. But the CFPB is looking at a lot of things in these inquiries. It's extensive. So it's some very basic stuff about sort of disclosures that might be provided or might not be provided. What's the process that the consumers are doing when they go through this? It seems to be a very it's almost non-existent. It's a very basic, almost an identification check. A lot of times consumers just need to verify who they are and where they live, and there's not sort of a big credit underwriting type of process that might normally go on with the lending type of product. So it just gets easier to essentially borrow more money and potentially harmful there. But these inquiries are going deeper too. The CFPB, keeping with the theme of what's being used with the data, they're very curious about the information that buy now, pay later companies are collecting, what they're doing with it. They now will have information not just about the actual purchases that were made, but also who was making these purchases, and they can tie them together potentially across multiple sites. So will this be now used for behavioral targeted advertising, and will this data be sold and monetized and all these different things? So it's a big inquiry. I think the states are very interested too, as we've been mentioning. A couple years ago, California, their DFPI, I think they're still they required some of the larger buy now pay later companies to get licenses. So this is looking like a loan product right now. A lot of these are interest free, but just figuring this all out as it grows during COVID and beyond is really important.
Right. And also already the Bureau has been pressuring companies, much like they have in the overdraft world, where some BNPL are going to do credit reporting and start sort of changing some of the processes for debt buyers and debt collectors, for instance, as the receivables market increases too with BNPL. There could be some, interesting relationships there as well. So a lot's evolving in that space. I think we'll see a lot more, obviously, for a lot of reasons in the next several months and within the year. Now, I'm switching gears. Fair lending is a hot topic, and to join us, and I'd like his reaction on this, Mike Bresnick, who has worked at the Department of Justice, knows Eric Halperin, the now head of the enforcement arm at the CFPB, but was also the head of fair lending enforcement over when he was at DOJ, both during the Obama administration. So, Mike, as a former DOJ attorney, what's your take on the combating of redlining and the initiative that's been launched?
Yeah, so I thought Len's description of Director Chopra was so evocative. I thought the language of pain and hostility reminded me of Rocky III when Clubber Lang was asked, for his prediction of the upcoming fight with Rocky, and he says pain. That kind of that's what reminded me, was thought of when Len was talking. But the reality is, I don't know Director Chopra. I certainly know his reputation. But the guy who's in charge of enforcement over there is Eric Halperin, and as Jonathan said, I know him well. I'm friends with him. We work closely together. I was director of the Financial Fraud Enforcement Task Force created by President Obama in the wake of the financial crisis. And one of the working groups over there was the Non-Discrimination Working Group, which focused on fair lending. And there was a lot of coordination between DOJ and OCC and the Fed and HUD and CFPB. And Eric was really taking the lead over there. It was Tom Perez was the Assistant Attorney General that was the co-chair of the group, but Eric was really doing the day-to-day work. And so I would work closely with Eric on those cases. And so, this recent settlement with Trustmark reminds me so much of what was going on when I was at DOJ, including, the Wells Fargo steering case there. The coordination between DOJ and OCC and CFPB has always been stronger. It certainly was strong when I was over at DOJ leading the task force, maybe not as much over the past 4 years. It's hard to say, but they're certainly ramping it up again now. I think that's what we can expect to see going forward. That certainly is what Attorney General Garland said when he announced that redlining initiative in October of 21, saying that DOJ is going to continue to work closely with OCC and CFPB. You saw that with the Trustmark case. Attorney General Garland said there are additional cases in the hopper, and they're going to open up new investigations. So clearly, this is something that they're focused on going forward.
And for folks that aren't familiar with it, even if you aren't directly involved in your fair lending compliance, the Trustmark case is an important one to look at because it is very specific to really a business decision, where a company does business, where it puts its advertising spend, and it really pushes the boundaries in that regard. It's got some classical themes, but sort of in a new wrapper with a new set of facts, and then therefore implications for anyone in the consumer loan space, or even really probably service providers as well. So please take a look at that. It's we have it posted here. Obviously, it's available on the web. Now,
I want to just one quick point is, Eric is aggressive. He is he's going to be an aggressive advocate for Director Chopra and the mission of the CFPB, I will say this: he is reasonable. He's a nice guy. He's going to take meetings. He's going to listen to you. He'll call, but he's going to be nice about it while he does it. That's all.
And another theme too is AI. And this was part of the redlining announcement initiative. Wrote Chopra weave that into his comments, and we just showed that quote. Andrew, the use of alternative data, machine learning, AI, it's permeating businesses. It is hitting all of the in-house counsel that we know are seeing this come up in every which way, whether it be on advertising and marketing, underwriting decisions, even decisions as to maybe how to service, certainly with respect to collections. AI engines are being used everywhere, but the classic themes still exist.
Yeah, I mean, it's interesting. AI, machine learning, these are terms that certainly over the last few years have become much more prominent, and there's lots of different services, and companies are finding ways to use these technologies, whether it's using, AI for anti-money laundering purposes to look for fraud in transactions or identity verification related services, or even coming up with underwriting models and trying to use new sources of data on individual characteristics or whatever it may be in order to come up with underwriting decisions. And regulators are very focused on this right now. On the one hand, the regulators will publicly say they encourage innovation, responsible innovation, of course, but they are supportive of AI and these types of things. But at the same time, there's a lot of risk involved in using them, particularly if you're talking about making underwriting decisions. And obviously, the concern there is if there is bias that is built in to a lending algorithm, or even if a company just doesn't really understand how its system works and isn't able to explain how that, you can be facing pretty significant fair lending type liabilities. And these are issues that the regulators are heavily focused on. What are the types of things that, and it's not just the CFPB. The banking regulators have been involved in providing guidance. The FTC has been involved, but certainly, I would just advise any company that's looking to build AI and alternative data or machine learning type concepts, particularly into their underwriting activities, understanding, how these systems are being set up, what were the decisions that went into creating them, how do they actually work? And that way you can kind of root out any potential bias or issues on the front end, and then monitoring how they're being used. And on the back end, trying to see, okay, what are the outcomes here? Are they raising any problems or any issues? And being able to demonstrate that you've thought about this and you've kind of taken all the steps needed to try to minimize this risk. That's going to be critical for when the time comes for a regulator investigates and starts asking questions, to be able to have kind of the paper trail to show the diligence and the monitoring and everything that you were doing to use these tools responsibly is going to be critical.
And in addition, this state AGs, state governments, and in this case, the DC City Council are getting involved. You have a scenario now where DC AG Carl Racine has introduced legislation on the use of algorithms and then would require disclosures. It seems from our perspective a bit of a sort of a first in terms of this type of a legislation package and disclosures being attached to the use of AI. But importantly, probably not the last. So something to think about, something that could be on the horizon that will be in an article or what have you about this legislation being introduced perhaps in other jurisdictions as well. And also perhaps something for those who are looking to mitigate the risk from a best practice, or at least an idea of what to think about in the future for implementing, maybe baking into product development. So in addition to that, it's transitioning a bit in the payments market. Ellen, Andrew, world that you work in a lot, there's been a couple developments in 2021 that are going to have a meaningful impact in 2022. If you could briefly walk us through those, that'd be great.
Yeah, Happy to do that, and I'll kick it off with some description of changes, at least in the visa rules, that are going to impact payment facilitators and marketplaces. So very briefly, a payment facilitator is a type of payments aggregator, a software company or payments company that goes out and they can actually sign up sub-merchants to receive payment processing services. This is a model that's become increasingly popular. It's used in a lot of different ways, but one of the big use cases that's being explored and kind of grown right now is there's all sorts of online platforms and marketplaces that operate online or even on mobile applications. And a lot of them don't necessarily want to go through the process of becoming a payments company themselves. And so the ability to embed another payment company's services into theirs in a very integrated, smooth process is a big aspect of what we're seeing in payments right now. And these visa rule changes for payment facilitators and marketplaces, which happened in October of last year, appear designed to help continue to facilitate that process, this kind of payment facilitation as a service that we're starting to see. And briefly, they just allow payment facilitators to kind of operate more globally, and also to provide services directly to marketplaces, which is an issue that was kind of open to some discussion previously. So that we expect to see a lot, at least on the business side from that. Ellen, do you want to maybe talk a little bit about what we see in the enforcement world?
Yeah, and I'll go through this quickly, but payments companies are in an interesting position because they really are the gatekeepers. They are moving the money between transactions, consumer transactions. They're also very much in a business-to-business role because they're business partners to merchants, with banks and otherwise. So they found themselves, of course, at the center of law enforcement interest for that role. But they're also, selling products and services themselves. So, the cases continue. We've talked about FTC and really some CFPB cases and investigations in this space for years now. The CFPB took a little bit of a break from it, I think, but in 2021 they did have a case or two. They were focused. I remember one case on a merchant, a payment processor supporting a tech support merchant, and so I think they're back in the game. States attorneys have gotten into this, so I think payments companies continue to sort of be in the crosshairs and in the crossfire. But so we'll have to pay attention to that. We can keep going.
Yeah,
Angie,
and just quickly, prepaid card update. So as we talked about in previous presentations, the CFPB has its prepaid rule that was adopted. PayPal had challenged that rule and got a favorable ruling at the district court back in 2020, where basically the prepaid card rule is short form disclosure and some of its credit linking requirements were invalidated. Just an update is that the CFPB has appealed that to the DC Circuit, and actually it is moving forward. Oral arguments, I guess, are expected shortly. So that's something to keep an eye on to see if that district court decision remains in place.
Okay, I'm going to take this one for as quickly as I can. Venable's Ad Law Group is doing a webinar on subscriptions, recurring billing in February. So we will get into a lot more detail here, but this is payments related, it's consumer related. This is a little bit more on the FTC side, but and states. But requirements for running a subscription program are certainly intensifying among the states. It's an important consumer protection issue, and lots of cases as well as class action lawsuits in this area. So in the interest of time, I'd encourage you to check out the webinar in February. And then I think here I mentioned earlier sort of a payments company sitting in the middle of a business-to-business type of transaction. Well, again, a lot of the times those businesses are smaller merchants. It's proven and that the FTC, will take jurisdiction over small business merchants and treat them as consumers. So, there are potential UDAP issues in the FTC world. That's unfair and deceptive acts and practices, potentially in, business-to-business dealings there. We've seen the FTC bring cases with things like equipment lease companies, merchant cash advances, There was a recent case on that front. And so another thing to keep watching.
I know that our colleague Chris, when talking about the legislative developments, talked about cryptocurrency becoming a focus. And we've certainly seen that in our practice as well. It's just an area that has really exploded in terms of additional exchanges that are coming online to help facilitate purchase of cryptocurrencies. You've got non-fungible tokens, which is really over the course of the last year have become a very popular product. And there's in-game currency and other aspects of online games using blockchain. All of these activities can raise a lot of different regulatory issues, whether it has to do with money transmission because the product or service is allowing for the exchange of cryptocurrency into fiat or whatever it may be. Those types of licensing issues are out there. There are even state-specific cryptocurrency licensing requirements that have been delivered, passed. If you just look at other regulatory issues, you've got anti-money laundering, OFAC economic sanctions issues. You've got SEC issues for anything that involves securities, CFTC issues for anything that involves commodities, and just basic UDAP advertising and marketing. The nuts and bolts of basic advertising and marketing is just as relevant. So that I think cryptocurrency is a big area to continue to keep an eye on. So from the payments perspective, we put together just a brief list here of kind of what to expect this year. And I think you can expect to see continued shift to online electronic payments, something that definitely accelerated because of the COVID pandemic. As we talked about, banking as a service, payments as a service, fintechs basically offering bundled services to customers is going to continue to expand rapidly. Real-time payments and different methods for speeding up settlement of payments will continue to be explored. The buy now, pay later product is, that Ellen and Jonathan talked about, including the heightened regulatory scrutiny that goes along with it, is something to definitely keep an eye on. And kind of related to that is, at least from the business perspective, is a continued focus on the customer experience at checkout. And part of that is where, buy now, pay later has been successful, but certainly other ways of embedding payments into the checkout process, maybe more traditional ways of doing kind of one-click payments will be explored a lot as an alternative to buy now, pay later. We expect, hopefully the Federal Reserve will be releasing a report on CBDC, which will give some insight as to where the Fed is thinking on that. We talked about the big tech orders, the use of data, which is critical to a payments company's action, business, also raises these regulatory issues and needs to be thought through carefully. And as Ellen talked about, there's always the enforcement risk, and that risk can involve not just providing products to consumers, but even providing products or services to small businesses now, if done in what's viewed as a deceptive way, can raise enforcement risks too.
Thank you, Ellen and Andrew. Now, there is still the classical day-to-day rulemaking and regulatory activity at the agencies, in particular the CFPB. And in a noteworthy manner, it's actually less than it usually has been. In part, that's because some of the rulemakings had been statutory. So it's in its first few years, now that the CFPB is in year 10, it has now dispensed with a lot of those statutory rulemakings, although it still has some authority and some loose ends to tie up, including the 1033 rulemaking on access to banking records and open banking. Now, that being said, you can see here, just by the sheer size of the list, there are a lot of things that have fallen off because they've either been addressed or they are no longer part of the agenda. But in particular, the access to consumer financial records is key. We know it's one that a lot of you are following. We get a lot of questions on that. And then there are also others at select banking agencies too here featured, and at the FTC, including expected at some point an announcement on the future parameters of the telemarketing sales rule and various other key things that touch on the consumer financial services space. And as mentioned, even the FTC with respect to the safeguards rule updates that take effect in 2022, we'll have a conversation about that in just a few moments. But just to highlight a couple of these regulatory rulemakings, you have Section 1033, that's the open financial data rulemaking. We're not sure when a final rule is expected, but this thing's been out there now for almost 5 years, and certainly has been sort of embedded into Dodd-Frank now for over 11. So this is something we've been looking, everybody's been looking at eagerly, anticipating, some in favor, some not, some in the middle. But nevertheless, it's something that certainly I think within the Rohit Chopra sort of parameters of his tenure at the CFPB, whether it's 3 additional years or longer, it probably come to some sort of fruition. And meanwhile, though, you have all this other stuff happening around the use of data. So this is one of many data points in that entire mix for those that are doing any counseling on business planning and the production of new products and services around data. Now, in addition to the use of data, you have the additional rulemaking that's happening in the rule of business lending data. And Ellen touched on business lending from the consumer protection, sort of small business consumer protection standpoint. And make no mistake about it, the CFPB is viewing it as sort of under their jurisdiction. But what is certainly under their jurisdiction, regardless of directorship, is this rulemaking around business lending data. There's just been some very recent announcements around this week, and certainly there's a number of parties involved in this debate. But long and the short is CFPB by statute is allowed to collect and ask the small business lending community to collect certain data points around fair lending an equal credit opportunity that they wouldn't typically necessarily collect in a nutshell. And as a result of that, there's a policy debate around that, as well as also what's next. We've got some stuff on our website about this, and certainly there's actually this week no shortage of articles about the issue as well. Now, in addition to this rulemaking on small business lending, the area where we've been focused a lot on today, and a theme, the use of artificial intelligence, is actually on the regulatory agenda for the CFPB. We get a lot of questions. How focused are they on the issue? I think this webinar, if anything, answers that. They're very focused on the use of AI. While the statutes that apply to the use of AI are classic, and the need for transparency, at least within a company, so counsel can advise appropriately on it, is significant. The realities are that AI, one way or another, is in scope at the Bureau, both from that marketplace review, perhaps in investigations and enforcement, and then also, of course, supervision, examinations of lenders and service providers, but also from a rulemaking standpoint. There's also one about automated valuation models over at the banking agencies to keep an eye on. It's at pre-rule stage, but again, for those involved in the policy work, you're probably well aware of this, but for those in product development work, you need to take this into account because this is happening as well. Now, a third-party risk management was an announcement that happened last year towards the end, in almost the final quarter of the year. And importantly, with third-party risk management, we have not done, we could do a separate one on service provider, separate session on service provider liability and oversight and compliance management. But the banking agencies re-release guidance on this, up their game. Everybody's upping their game and looking at service providers and third-party risk. You've all been hearing that to the extent you've been in this world, since the beginning of being in it. Many of you are a part of working in that. It's a hot topic, continues to be so. So now I'm going to turn it over to Julia Tama and Katie Marshall for the privacy and data security update.
Thanks so much, Jonathan. So the first place that we'd like to start is just by talking for a few minutes about we can skip this slide, Jonathan, because it's the topics we'll talk about. So we'll just take them in turn since we're getting towards the end of the time. So the first topic that we'll tackle is the arrival of Director Chopra at the CFPB. We've heard a lot about that today. So just continuing the theme of this being kind of a precursor to maybe some changes in how we see regulation and enforcement. One of the things that in the privacy and security world we look at is we are expecting Director Chopra to import to the CFPB some of the FTC's historical approach to privacy and data security. And that's really important because the CFPB having its UDAP authority with 2 A's, it's very similar to the FTC's UDAP authority with 1 A. And the FTC has routinely used and for a long time has used that authority to bring enforcement actions relating to privacy and data security. So they've kind of interpreted it to encompass a number of privacy and data security concerns. Director Chopra is obviously very familiar with that approach from the FTC, was deeply engaged in it, deeply concerned with it, and we expect that to appear in the CFPB and maybe see a more vigorous exercise of those authorities at the CFPB with the entities that are under CFPB jurisdiction. In particular, we might see, for example, exercise of deception authority related to data security. The CFPB already examines on this. You see it in the examination manual. We could also potentially see some use of unfairness authority against certain shortcomings or alleged shortcomings on data security safeguards. That's something that we have seen at the FTC as well. So that could appear now at the other agency. We also wanted to talk for a few minutes about the changes at the FTC to the Glba safeguards rule. This was in the hopper and under consideration at the FTC from even before the pandemic, but it was issued in its final form in October. October 2021, the compliance deadline then is a year from that in October 2022. This is important there because it is making the requirements for data security much more detailed for those entities that are under jurisdiction of the safeguards rule. So historically, the safeguards rule run by the FTC was kind of high level and didn't have a ton of detail if you compared it to the versions of security regulations that were issued by the other federal financial regulators. Now, the FTC has kind of stepped it up and added a lot more detail, some more prescriptive requirements that are similar both to the other federal agencies that are regulating financial institutions, and also it looks a lot like the New York Department of Financial Services and their cybersecurity regulation, which was issued a few years back and is pretty detailed as well. So key changes in that, what we see is requirements specifically related to implementation and review of access control. So making sure people are limited in how they can access personal data. We see encryption, we see requirements related to data disposal, and then also change management. So when you're changing your systems, those are things that might have been part of your security program before, but now we see a much more explicit requirement. Also in terms of just process and bureaucracy, what they want to see is a qualified individual who's responsible for the program and regularly reports to the board of directors or the governing body. There are some smaller institutions who are going to be exempt from some of these things, so it's worth looking at it in detail, but those are the highlights. I'll hand it over to Katie now to talk about some of our other topics.
Thanks, Julia. Another notable recent regulatory action that we wanted to highlight is the promulgation of the Security Incident Notification Final Rule. This jointly issued final rule was finalized in November and will require banking organizations to notify their primary federal regulator of significant computer security incidents as soon as possible, but within 36 hours of determining that a notification incident has occurred. Banking organizations subject to the rule include a variety of entity types, such as national banks, federal savings associations, and insured state non-member banks. The rule, however, is limited in the sense that it does not require banking organizations to notify with respect to all cybersecurity incidents. Instead, only significant incidents, such as those that materially disrupt the organization's ability to carry out its activities to a material portion of its customer base, are subject to the notification requirements. Additionally, unlike the safeguards rule, the security incident notification rule imposes obligations directly on bank service providers for certain events. So as these rules go into effect this year, covered organizations should just remain aware of any changing obligations. We can advance to the next one. Moving from regulation to enforcement, this has been discussed a little bit in the presentation, but we just wanted to highlight that data breach enforcement in the financial services industry remains very active. Most notably, the New York State Department of Financial Services has been increasingly active in this space and issued its first penalty under its 2017 cybersecurity regulation in 2021. This settlement was particularly noteworthy, not only because it was the first, but also because the non-compliance was discovered during a routine assessment by NYDFS. Okay, move on. Finally, on the privacy front, we wanted to preview some key updates on the state privacy laws. You may be aware of the California Consumer Privacy Act, or CCPA, which went into effect in 2020. This law will be significantly expanded and revised by the California Privacy Rights Act in 2023, known as the CPRA. Additionally, both Virginia and Colorado enacted somewhat similar comprehensive privacy laws in 2021 that will go into effect in 2023, as seen here. And as an aside, states continue to be quite active on the privacy legislation front, and it's likely that other states will advance similar legislation this year, such as potentially New York and Florida. The forthcoming laws in California, Virginia, and Colorado are all rights-based privacy laws. These laws largely exempt information that is subject to the GLBA or FCRA, but the exemptions do vary by state. Therefore, an entity that's primarily regulated by such laws may continue to have obligations under these state laws as well. Notably, these laws may require regulated businesses to provide certain disclosures to individuals through privacy policies, provide certain rights to individuals, and may require the imposition of certain contractual obligations with respect to service providers or sub-processors. And additionally, the Virginia and Colorado laws diverge perhaps most notably from the existing CCPA by requiring opt-in consent prior to processing sensitive data. Sensitive data is defined somewhat broadly under these laws and includes, but is not limited to, personal data revealing racial or ethnic origin, religious beliefs, or citizenship or immigration status. And with respect to Virginia's law, also includes some precise geolocation information as well. We can move to the next slide. This slide just provides a quick overview of the distinctions between the CCPA and these forthcoming laws. As you can see, there is a lot in common, but these new laws do significantly expand obligations that companies complying with the CCPA may need to address to come into compliance starting in 2023. And with that, I'll turn it back to Jonathan.
Thanks, Katie, and thanks, Julia. No shortage of topics there that are going to be important to know about. I think there's already some legislation for 2022 that's in the pending in the hopper in various legislatures that I know you're tracking. I also know too that not all the legislators have even come back yet for their sessions that are going to be 2022 years. And so, this is going to be a hot topic, I think, for people to keep their eye on. Seems like things are starting to come to fruition too, with the 2017 New York DFS, just in their view, probably bearing some fruit and some non-compliance that they've identified, and that it came through an examination and is also important to note because there's certainly no shortage of examinations taking place out there. And so to switch gears, the CFPB, of course, switched to examinations virtually in the COVID period, but has also shifted to COVID examinations too, targeted exams, but shifted back about halfway through 2021 and is moving forward. A lot of those sort of first round post-COVID targeted exams have finished up, and examinees have received the reports, and maybe in the course of some back and forth with the Bureau, but that'll continue. We expect that to continue. Now, Alex, that being said, whether it's coming from an exam or it's coming through an investigation, the enforcement agenda is robust. We've talked about a lot of it, but what are some of the other highlights that you want people to know about that we haven't touched on yet?
Sure, and Len and I are going to tag team this one too, but as we both mentioned and emphasized, settling investigations and matters with the CFPB and the FTC is going to be increasingly more difficult because, as Len mentioned, Chairman Chopra and the commissioners at the FTC are seeking both specific and general deterrence in these settlements. And they've made very clear and have really set out actually roadmaps in some of their writings as to what that means. And first and foremost, looking for accountability for top leadership in an organization. Of course, there are legal standards that the agencies need to meet in order to obtain to get liability for individuals, CEOs, directors, employees, etc. But it's a pretty low standard. We could talk more specifics, but for purposes of today's webinar, it's often a tool for negotiating settlements, and we've had actually found difficult to convince the commissioners at the FTC and the CFPB that individual liability is not warranted. And I'll let Len comment on that a little bit more.
So the FTC's remedial arsenal is a little bit hampered right now. As many of you know, last May, the Supreme Court took away the FTC's ability to get equitable monetary relief utilizing Section 13B. The FTC has tried to get a legislative fix. That's stalled. There's also been, as I mentioned earlier, a push to perhaps give the FTC direct civil penalty authority for violations of Section 5. Not clear where that's going. But the FTC isn't just sitting on its thumbs. It's using its ability to enforce provisions of Gramm-Leach-Bliley aggressively. There's a provision in GLB that says if you obtain a consumer's bank account information by false premises, by deception, that's a violation. For that violation, the FTC could either seek civil penalties or redress under Section 19. I think you're going to see that. I think you're going to see it not just with what we would normally think of as consumers, but with small businesses, and we've already seen that in the Richmond Capital case. The FTC also is going to continue to take aggressive positions in settlement, even if they might not get that relief. And there's been colloquy among the commissions about whether that's appropriate, that it's, in the words of Commissioner Wilson, akin to extortion, and words of Commissioner Khan, these people are guilty, they ought to pay. So, I think you're going to see that. I think you're going to see enhanced use of the Restore Online Shoppers Confidence Act. And very aggressive as to what that covers, because again, that's a statute where the FTC doesn't have to rely on Section 13B to get relief. They can use Section 19, which is still intact, or civil penalties. So just because the FTC has lost its 13B authority, it's going to continue. And at the CFPB, they're going to take a continued, very aggressive view of their jurisdiction. I think who is a covered person they're going to continue to push the envelope. And exactly where remains to be seen, but they've got a big budget, and I think they're going to use it. And, the National Collegiate Master Trust is an example there, but I think you're going to see even more aggressive uses than a loan trust of people who the CFPB contends are covered people.
Yeah, and just finally, I think we've seen Rohit Chopra be relatively creative in how the statutory tools given to then the FTC, now the CFPB, are used to kind of get the end that he's looking for. I think the entities that are subject to the CFPB supervision authority and therefore subject to regular supervision examinations will see more of a kind of the routine engagement with their supervisors. But as we saw in earlier years with the CFPB, the Office of Supervision is in the same division as enforcement. The stakeholders that are convened to consider a supervised entity's kind of examination outcome include enforcement staff. They work closely together, and ultimately supervision recognizes that their enforcement arm has the tools really to really force compliance, and so there's no shyness in turning over the case to their enforcement colleagues. And I think we are going to see that increase and ramp up as Chopra, finalizes kind of his staffing, which has taken some time, understandably. And, the examinations that have been taking place virtually during COVID close out. Jonathan?
Thank you, Alex, and thank you, Len. A lot there. There's also folks who are interested in enforcement and the posture at the Bureau and the FTC and all of the federal banking agencies and states. Consumer Financial Services Enforcement Update on our website. It's a webinar recording, PowerPoint for download and watching at your convenience, even on YouTube, available on our website at CFS/publications. So that's venable.com/CFS/publications. And then in addition, the states have been very active. And as we foretold, we're coming up at the end, but we want to make sure that we hit some of this. And so importantly, there's no shortage of activity at the states, and in particular, with state licensing. This here is a water bottle from the last in-person MLS conference where everybody convened in San Francisco and right before the pandemic. And they're promising at the time NMLS 2020 refresh modernization. And we're starting to see some of that. It had been in the works for a long time. Certainly as practitioners and anyone involved in state licensing knows, the system has its quirks and can only improve. But those that are using it have expanded, whether it be a California DFPI in the debt collection space with the licensing that started taking effect on January 1, all the way through a lot of different verticals and licensing categories in the sales finance space, in the money transmission space, and certainly in the consumer lending space. In addition to mortgage, you have a lot more on the system than ever before. And for anyone, whether doing downstream compliance or any type of even merger and acquisition due diligence and change of control, or even trying to determine or convince, in some cases, who the control persons to provide personal information for licensing purposes has become much more challenging than ever before. It's an area we're doing a lot of work in, and certainly we know it's one that in-house counsel have to contend with that handle licensing and compliance. In addition, there's laws pending in Maine, Kansas, and New Mexico to still keep your eyes on, in addition to anything else that's sort of introduced in 2022. And as mentioned before, there's no shortage of interest in fintech. And this screenshot here on the left-hand side of the slide is from the Washington State Department of Financial Institutions. It has a whole fintech library, all sorts of great resources, including beyond Washington State, for anybody looking for more info on fintech and states. And they just put a lot of effort and energy into it. It's a real neat service worth taking a look at. So before we wrap up and before we provide today's CLE code, we certainly want to thank everybody for joining us today. This is what we enjoy doing, whether it's for a client or generally education. All of us like sharing what we're working and living in the middle of, and helping you get the support that you need and the knowledge to support your clients and companies and business initiatives, as well as also your careers. So we certainly thank you for attending. Having looked at some of the attendee lists today, folks that are logged in, you know who you are, but some of you have been on since the beginning, meaning going back almost 10 years ago now. We really thank you for your support. And on behalf of Ellen, Andrew, Michael, Len, Alex, Sarah, myself, of course, Chris, Julia, and Katie, we want to thank you for joining us today. It's been our pleasure to present this. We welcome any questions you have. We'll certainly try to get those answers back to you offline, and certainly welcome your feedback. It helps us decide where we go with the next webinar and our articles, our writing, and we very much look forward to seeing you either virtually or in person at various conferences, including the upcoming Receivables Management Association meeting, some MAC and payments events, as well as also upcoming PLI on prepaid, as well as also some ACC, American Corporate Council events coming up this spring. So for today's CLE code, for those that need it, it is Compliance 2022. Thank you very much for joining today. That's all we got here in Washington, D.C., New York, and from Venable. Thank you.